Thanks for joining us at XM.com for the special report. Stock markets started the new year on a strong note, even though we've seen some of those gains evaporate lately. The question is, can this rally continue? I'm Christina Marujos. With me today is our senior investment analyst, Marios Hadjikyriacos. So, Marios, with stress emerging in the banking system, we've seen some of this euphoria fading. So, how would you describe the current environment for stocks, and what are the lingering risks right now?
Hello, Christina. So I guess we have to start with the elephant in the room, which is what has been happening in the US banking system. So crisis averted for now. Yeah, that's the news that we got on early on Monday. So the US government and the Fed are stepping in. They're going to guarantee the depositors in Silicon Valley Bank, and they've also set up a new facility that would allow banks an easier time in getting access to funds in case they are in trouble. So we've gotten some good news on the banking system. Now, the problem is the stock market hasn't really reacted to those news as much as you would expect. So we're recording this on Monday, and the Wall Street futures haven't even been able to surpass the highs that they reached on Friday after the non-farm payrolls report. So good news, but the market doesn't really seem to be buying it so far. So let's take a step back. What has enabled this rally that we saw in US stock markets since the beginning of the year? Well, I think it was a combination of good economic news and some liquidity injection. So the economic data out of the US has certainly been stronger than expected lately. Everything from consumer demand to inflation, to the jobs market, the economy seems to be doing just fine, at least for now. And that has really calmed nerves around an imminent recession. The final, and I think the bigger part of why stock markets have been in such a euphoric mood, or at least they were in recent weeks, were liquidity injections from major central banks. So the Fed is reducing its balance sheet, right? Everybody is familiar with that. Well, since the Fed started to reduce its balance sheet, it has reduced it by around $500 billion. So it has drained almost $500 billion out of the financial system over the last year. Now, the Bank of Japan alone, since October, has increased its balance sheet by $800 billion. So that means that, yes, the Fed has been taking money out of the system, which in theory is negative for assets like stocks, for riskier investments, but the Bank of Japan has been more than offsetting that process. And of course, liquidity is a global phenomenon, right? Now, that's what got us here, I believe. Now, the question is, where do we go from here? And to that, the answer is not so bright, Christina, and I'd be happy to elaborate on that.
Yes, I was going to ask you, so taking all of this into account, Marios, how does the risk-reward looking moving forward?
Well, I think it's pretty unattractive where we stand now. So we have a situation where the S&P 500 is trading at 17 to 18 times this year's earnings. Now, that is a very expensive valuation, historically expensive, in fact. It makes sense only if interest rates are very low, so that means the investor doesn't have an alternative and they almost have to buy stocks, or if corporate profits are growing very quickly. Well, neither is the case today. Interest rates are very high and rising, and corporate earnings are actually declining. Corporate earnings fell from last year in the latest reporting season. So that is a dangerous cocktail, I think, for stock markets. When you have an expensive stock market and at the same time the investor has the alternative to buy, a US government bond that pays them 4 or 5% just to wait, well, that's a bad setup for stock markets. So of course, the other leg of that is, yes, recession nerves have calmed down for now, but I don't think they have disappeared. The New York Fed has a model that calculates the recession probabilities based on the bond market prices, and that model points to a 57% chance of recession over the next year, which is really, really elevated. So in a sense, I think that recession concerns have been pushed back, recession risks have been pushed back into the future, but they haven't really disappeared. So what's next for the markets? I think that the outlook is negative. I would not be surprised to see new lows for the stock market. And just to, how low might the market go? Well, if you go back over the last century, since the Great Depression, the average decline in the S&P 500 during bear markets has been around 33% from top to bottom. Now, if we assume something similar this time, then that suggests that the S&P 500 might have another 16 or 17% downside from the levels that we are trading today. So that would be more consistent with fair value, right, in terms of valuations. And it's also a very critical area in terms of charts and technical analysis. So are we going to get that low? Who knows, right? Maybe not, maybe we don't. But the risk to reward does not seem attractive where we are trading today, but it would become more attractive as we approach that 33% drawdown. So in conclusion, Christina, valuations, earnings, the macro environment, everything suggests that the outlook is negative, but investors should not miss the big picture. Every crisis eventually passes and stock markets move higher over the years.
I like leaving things on a positive note. Marios, thanks so much. This was a special report here at exam.com.